Good morning, everyone. Welcome to the morning kappa at 8 on a Wednesday. I'm here to present the midweek futures traders technical brief, and we are on week 3, October 2025. As per the usual, every Wednesday we'll go through this table whereby the most popular products being traded by traders. And noticeably, the week before, we have seen that markets have actually moved into a more neutral setup, and we can see the categorization quite clearly here. For the indices, including the US indices as well as Hong Kong, China, and also the Nikkei, all have moved into a neutral setup, which means that a lot of the indices have gone to new high but have retraced after achieving the new high and now trading in a range. For agriculture, it is pretty obvious that from a position whereby it was more uncertain, all the coverage here that we have, corn, soybean oil, and soybean, all have moved into a negative setup, which means that there would be more potential downside. And for metals, right, it is been on the tear, and we have seen consistently week after week prices have reached new highs, and copper, which broke out the previous week, is still trading on a positive as well. For crude oil, from a neutral position, it's moved down to negative, and due to the recent sell down. I'll move on to our local product for FCPO, and basically FCPO has been basically weighed down by cautious investor sentiment and the expectation of rising inventories as productions continue to increase. And also there is a piece of news from Indonesia whereby the government may regulate exports of crude palm oil to ensure there is enough supply to produce biodiesel. The world's biggest producer of palm oil has implemented a biofuel program, blending palm oil fuel with diesel for more than a decade to reduce the reliance on fuel imports. The current mandate is 40% palm oil with diesel. So as we notice from the chart above, we are looking at a possible support below the 4,400 level. Currently, as mentioned, it is neutral. The recent rebound has seen prices coming down again. And for the first product that we're going to cover for our market guide, it is the natural gas. US natural gas futures have been driven mainly by storage levels which remain above average, and also strong weather-driven demand is lacking. Storage of 4.5 to 5% is above the 5-year average and is a little on the high side, moving into back end of October. This is because we probably will see a seasonal change to colder temperature. But we check out the 6 to 10 days temperature outlook in the US. Largely, we can see that the temperatures on the eastern side remains to be in high temperatures. Only on the western side, there are some areas whereby the temperatures are on the lower end. So all in all, the US temperature outlook, all right, or the weather outlook is that there is still no threat of a cold front, and therefore this would impact the prices of natural gas. So for today, we have this market guide whereby we have the natural gas in view. This is the November 2025 contract. And for existing profile, also short-term chart setup, it is negative. The current price of micro natural gas is at 3.01. We have a reference price of 3.11 and a potential profit price of 2.95, giving us a value of 160 US dollar, and also a potential loss price of above 3.25, giving a potential loss of 140 US dollar. Moving ahead to corn, also corn, as mentioned in the beginning, after a period of consolidation, it appears that prices are having a downward momentum. Basically, grain traders and analysts are unsure of what the crop yields are like as full harvesting hits full speed in the Corn Belt. CFTC and the USDA reports are still not available due to the US government shutdown. These reports are obviously very important, and therefore, without it, there is very little visibility for the traders and analysts alike. And what is actually happening here is much of the sentiment is on the ground and only limited to a very small group of players. And usually these are the major players with assets in the Corn Belt. So for corn, we are also looking at a profile of negative and also a setup of that is negative. And this is the December contract that we are looking at. And the current price at the time of writing is 411.0. And we are looking at a reference price of 414, looking for a slight rebound. And thereafter, the potential profit price that we're looking at is 407, giving us a value of 350 US dollar, and the potential loss price if it rises above the 417. So do take note of the termination price as well. And this will give us a loss of USD 150 US dollar. So this is all for my presentation. I'll pass on to the next speaker. Thank you so much.
All right. Morning, everyone. Welcome back to Morning Kappa at 8. So look at the Hang Seng Index. You have extended the correction yesterday. Right now, the index is trading below both 20 and 50 days moving average. Now, although that the yesterday night at the evening sessions, the Hang Seng staged a rebound, but it has yet to cross above the 50 days moving average. So on the downside, we kept the support at 25,000 point level, and this will be a very critical psychological support for the Hang Seng Index. We kept that for the most part of this year, it has been trading below the 25,000 point, and it managed to break past the 25,000 point in the late July. And so right now, as of yesterday, the index have been consolidating above this 25,000 point. So this will be a very crucial make or break level for the Hang Seng Index. Now, as of looking at the heat map across the sectors in the market, right, you can see that the sentiment very bearish on the tech stocks after the last week. Like Trump and China, they fall back into the trade tensions again. You pick up the some of the lines that mentioned by the Trump, right? Seemingly he's going to restrict the export of US technologies to the world, especially on China. So looking at this heat map, you can see that yesterday the biggest casualty was the Alibaba 9988. It went down by 4%. Not only it went down by 4%, it went down with price and volume together. Second casualties was the Tencent that went down by another 3%. And then on, SMIC has suffered a very big loss yesterday. It went down by 8%, right? So the only comfort is that the funds are actually moving out from the high beta sectors or tech stocks, and they are moving to a low beta, more defensive stocks, such as the banks and the insurance companies. So that's how the market actually move during the bear market, and some actually pick up some of the telco stock as well. So among all the stocks that we've seen here, right, PopMart have been quite resilient as of yesterday. Okay. Uh, so yesterday night, the HXC also staged a rebound, but you do see that the HXC have yet to cross above the 50 days moving average as well. So that's actually in line with what we saw during the daytime at the Hang Seng market. So right now, both daytime Hang Seng and the evening time HXC both are showing a weak sentiment so far. Right. So as of trading stocks this morning, we'll be looking at a bit of defensive counters, such as the China Construction Bank 939. Yesterday, have staged a breakout, a climb above 7 Hong Kong dollar 40 cents. We think that the momentum should continue, where the CCB will be testing $7.80, followed by $8.20. Downside support is $7.20. And then on the shipping company, Costco Shipping 1919, also jumped higher yesterday, crossed above the 12 Hong Kong dollar 40 cents on the back of high volume. So the momentum follow through. Costco will be testing 13 and followed by 13 and a half. Downside support is marked at 11 and 80 cents. Right, and let's move to the US market. Firstly, look at the Europe market. It managed to bounce off the 20 days moving average yesterday, keeping the bullish setup intact. And S&P 500 initially had corrections due to the Asian market, but then on after release result by JP Morgan and Goldman Sachs, right, that given a brighter outlook, the market have started to actually recoup their intraday losses and close with a bullish candlestick. At this juncture, overall, the setup remains bullish for S&P 500. So looking at the heat map again on the S&P index, you'll be surprised to see that the bigger cap, Nvidia, Tesla, Amazon, is actually undergoing corrections. But most part of the market, looking at the smaller cap, the counters mostly close in a positive territory. So yesterday, the smaller cap stocks have basically outpaced the bigger cap stocks. And as for Nvidia, we do see that the funds are rotating out from Nvidia and going into the AMD, right? So that's actually what happening between over here as well. So yesterday, the US market basically also support by a very strong sentiment in the finance stocks, led by the Citi, JP Morgan, Wells Fargo, as well as the Bank of America. So looking at this week, the some of the stocks have yet to announce their result, such as like Bank of America, Morgan Stanley. Now you look at the US, right? If most of the bank deliver good positive results, do expect that Bank of America and Morgan Stanley to deliver a similar set of results that actually give us a bit of trading opportunities in these counters, right? And also this week, another stocks actually have a good proxy on the consumer sector would be the American Express that are going to release their results later part of the week. So I've reshuffled the US watch list and spell out a few of the sectors or teams that are actually quite interested. I think right now most eye are on the AI servers, but not to forget, right? Well, AI and servers, the team is there together with the memory, right? One of the segment that actually quite interesting is actually the cybersecurity, led by the Palo Alto, CrowdStrike, Datadog, CyberArk, and ZX. So right now, the US also see a very high demand on the utilities and power. So you can actually look at the relative and telecommunications, COHR. Then on yesterday, the banks have released their results, but another group of stocks have yet to release the result, which are the fintech company, such as the Sofitech, Affirm, Upstart, Ally, and QTWO. Right, and then on, you also know that US have passed the smart law that actually give rise to a strong demand on the stable coin. So some of the crypto related counters such as the coin, MSTR, that you can actually put onto your watch list as well. Some of the B2C counters that we are going to look at, just to recall, a few days ago, DAL, Delta Airlines, have actually released a very good set of results, and they have even upgraded their guidance on the Q4. Right, I think that looking at the US, the consumer sector are still very hot right now. So these are some of the stocks that actually put under the B2C segment, and pay attention to ABNB, where their majority consumer market is actually North America, i.e. US. Okay. Right, so we'll be looking at the ABNB, which managed to bounce off the 120 support level. So if the momentum follow through, right, together with the result they're going to announce next week, right, hopefully the ABNB will break past the resistance to resume their upwards movement. Then on, since the banks are giving good results, I do expect their peers, which is the fintech company, to deliver a similar set of result and outlook as well. So looking at the Sofitech, right, I managed to bounce off yesterday, cross above the 27 US dollar, so heading towards this 29 and followed by 31 US dollar level. So over at Malaysia market, FKLI remains mild profit taking yesterday. The bulls are taking a breather right now, and the FCPO is seen drifting lower due to the weak export number so far, right? And as for Malaysia market, looking at the heat map, right, we can see that the big cap, especially the banks, are experiencing profit taking right now. But there's a some of the funds actually rotating to a defensive play, which is the consumer market. So you can see that Mr. DIY, Speedmart, and EcoShop actually bounced off yesterday. And right now, look at our strategy report. We still have a buy call on the Mr. DIY, right? And a bit of the other counters also garnered market attention, such as the McLean yesterday, and then on the Mitra, Jaya, Unique Fire, and so forth. So you can actually look at the heat map here, then you can see what the stocks that actually garnered attention yesterday. So for our technical trading stocks this morning, we'll be looking at firstly the Westport, which are climbed above 5 ringgit and 30 cents. So the breakout Westport should be moving towards 5 ringgit and 60, and followed by 5 ringgit 80. Downside supports market at 5 ringgit and 10 cents. Then on we have Sam Aiden, which also break past 1 ringgit and 45 cents. Eyeing to test the next resistance at 1 ringgit and 55, and followed by 1 ringgit and 65. Downside support is marked at 1 ringgit and 35 cents. So we have two breakout stock this morning, Westports, followed by Sam Aiden. So I'll stop here and pass on to Lee Leng on the Plantation report. Thank you.
Hi, good morning. Today we've got a Plantation's report for you, just to talk a little bit about the strategy going into 2025, fourth quarter of 2025 and 2026. So just looking at CPO prices, what we have seen is that spot CPO prices have actually bounced back to current levels. So currently it's at about 4,004 to 4,500 ringgit per ton. and it's bounced back from about 3,780 in May. So we believe this was likely due to the postponement of the US-China tariff decision by 90 days, which led to a recovery in soybean oil prices and therefore CPO. And that was on the expectation that China will actually have extra time to stock up on US soybean if needed. And then, of course, around the same time, we saw the Indonesian government saying that they will continue to push through with the B50 biodiesel mandate in 2026, although they said that the starting timeline would not be in January. So with the US-China tariff deadline extension, despite the fact that we saw the initial spike in soybean and soybean oil prices, we know that it has since fallen back. Because obviously the traders realized that China did not come back into the market and they did not buy any soybeans at all. In fact, the latest 100% US tariffs that US is slapping on China is probably likely to make things worse, and China is looking to retaliate. And of course, this was further exacerbated by Argentina temporarily eliminating export taxes on soy, corn, wheat, and all the byproducts. And this was from mid-September to end of October. So this is a significant reduction from their export tax, which was at 26% for soybeans previously. So as a result of this, we saw China buying a lot more Argentinian soybean and not buying any of US soy. In fact, if you look at the normal or typical year, China would actually buy more than half of US soybean exports. But in 2025, this has dropped significantly to about 29% of total exports in the period of January to May, and there were 0 shipments in June to August. But despite this, you look at China soybean imports, it actually hit record highs in May, June, July, August, and that was because they have been buying a lot of South American imports. So China made up something like 76% of China's total soybean exports in the first 8 months of the year, versus a traditional level of 65 to 75%. So how does this relate to palm oil? So essentially, if China doesn't come back to buy any US soybeans, then US will be left with a lot of stock of soybeans. And Oil World is currently forecasting end August stock usage ratio in the US to be at 12%, which is a multi-year high. And obviously then global stock usage ratio will also be very high. The forecast for Oil World is at 29.5% in 2026, up, which is, would exert pressure on soybean and soybean oil prices, and therefore make CPO prices less competitive. So we've already seen this happening because, as mentioned, soybean prices have fallen of late, and we've now seen the CPO soybean oil price discount narrow by 55% over the last 3 weeks, and currently at $42 per ton. From a high of $263 per ton in June. So if this continues, then we would see demand destruction happening, which is basically what we saw in the first few months of 2025, where India switched their buying to soybean oil instead of CPO, and therefore year-to-date August imports of palm oil from India is down by 18% year-on-year. So we may see this continuing going forward, assuming the price discount remains narrow. The other thing that could potentially change this is La Nina. If it does come, and currently there's a 71% chance that it can develop over the next 3 months. If that does happen, then the South American planting season, which starts in October, November, that could be affected. So we need to watch out for that. The other thing, of course, that would be the biggest catalyst for CPO would obviously be the Indonesian biodiesel mandate. We have seen recently that Indonesia has said that they will continue with this mandate in 2026, and that they will have to reduce their exports of palm oil by 5.3 million tons as a result, and that's a 20% decrease. But they also had a caveat saying that if CPO prices are too high, then they might bring it back down to B40, and then when prices go up again, then they will reimpose the B50. So it's still looking a bit iffy, but they did mention that B50 is undergoing trials, and the final testing would require around another 6 to 8 months. Of course, there are still a lot of experts who say that this is difficult to push through, given that there's still technical issues, there's still a shortage of biodiesel capacity, and then of course there's food versus fuel debate, and then of course at the end of the day, funding is still a big question mark. Our initial assumption was that B50 would not take place in 2026 because of all the issues that we mentioned, and that we will not see this impact coming through. But now we are assuming that B50 will take place, but only from July onwards. So this means that we are assuming a half-year impact, which is 2.65 million tons of CPO to be used for biodiesel in 2026. And this is what we are now pricing into our assumptions. We have a couple of tables as well in the report. You can see how, at B50, what will happen is that you will have less exports of palm oil, which means less levy collected, and therefore there will be definitely a massive funding shortage. We estimate at current POGO spread, the shortage will be somewhere around about 1.2 to 1.7 billion US dollars in terms of shortage of fund requirements. We also know that B40 itself is also currently behind schedule, and so there will need to be a bit of a catch up towards the year end, and of course going into B50 into the next year. So if you were to look at the All World's numbers for the 17 oils and fats, they have said that there will be a decline in stock usage ratios in 2026. They actually recently revised their forecast to include the B50 mandate, and as a result of that, they have assumed that the stock usage ratio will actually fall for the 17 oils and fats to 12.4%. In 2026 from 12.8%. Previously was an increase that they had forecasted. But of course, they are still assuming that there will be a growth in production coming from sunflower, rapeseed, and soybean supplies. But if we were to use their 2025 as a base and assume only a half-year impact of B50, then we would actually see that the 17 oils and fats stock usage ratio would actually rise instead in 2026 to 13.6% from 12.8%. So this means that, and this 13.6% is basically the historical average. So this means that, if you assume half-year impact, then the global stock levels would actually be at a comfortable level for 2026, instead of a tight scenario. So in the immediate term, we do expect that prices will still remain volatile because of the ever-changing geopolitical situation. In the medium term, with our assumption of a half-year B50 impact in 2026, then we expect that 2026 will be a more balanced year, with flattish to slightly lower year-on-year CPO prices. Because we assume that stock usage ratios will still be at a comfortable level. What we would also potentially see is that, while demand from Indonesia will increase because of the B50 mandate, demand from other sources may be rationed because of the small price discount between CPO and soybean oil. So with this, we have raised our CPO price assumption to 4,350 from 4,100 per ton for 2025 and to 4,250 from 4,000 ringgit per ton for 2026. Our PK price assumptions are also raised accordingly. In terms of earnings changes, however, we will only make them over the next month. What we also wanted to highlight is if you look at the recent share price movement for the plantation companies, with the recent run-up in the CPO prices over the last 5 months, we've also seen that the share prices have also somewhat re-rated. And this share price movement in 2025 is much more reflective of CPO price movements than the run-up we saw in 2024. In 2024, we saw CPO prices rising about 28% from the low in August 2024 all the way to 4,009. But we saw the KL Plantation Index only increase by about 8% during that same period. This time around, CPO prices have moved up about 19%. But the KL Plantation Index rose by 9%. So the gap is much closer this time round. And we also see the same pattern in the share prices of the regional planters, where in the same period, over the last 5 months, share prices of the regional planters rose by an average of 25%. So as such, we think that the share prices have somewhat priced in the improved price direction for 2025 and 2026. And we think that therefore any upward consensus CPO price projections adjustments would not re-rate the sector significantly going forward. So we have therefore made no changes to our neutral sector call, where our top picks are unchanged. Focus on value plays, which are JPG, SOP, LSIP, and IOI, and situational plays, which are SDGA 3 and First Resources. So I think that's all that we have for today. Thank you for joining us. Happy trading, and see you again tomorrow at RSB Morning Cuppa at 8.